Good evening, everybody, and welcome to the webinar of RSP Mortgage Investing. We're going to be talking a little bit about that tonight. We're going to introduce you to a pretty exciting way of investing in mortgages using your RSP. I want to thank everybody for joining us tonight, and if you have any questions during the presentation, just type them into the chat, and I will address them at the end of the presentation. And I'll talk to you at the end of the presentation. It shouldn't be too long. I don't want to hold this up too long. I know Wednesday night's a busy time for people, so we'll get right to the matter at hand. We'll discuss the strategy, answer a few questions if you have any. If you don't, that's no problem. And then we'll let everybody get on with their evening. Folks, good evening. My name is Walter Montero. I'm the author of an online book called The RSP Mortgage Investor. I wrote it in 2008. It's been quite a while, and I show people how to invest in mortgages using their RSP. I just want to tell you a little bit about my story, how I came upon this strategy. I'm a real estate agent in Cambridge, Ontario. I co-own a real estate company and a mortgage company with my wife, Karen. We've been in, I should say I've been in the real estate business for 28 years, and I've been in the mortgage business since 1996. And the way I came upon this strategy was through my daily practice of real estate sales. So what had happened was, because I was a duly licensed agent, I dabbled more in mortgages back then than I do now. I do actually own a mortgage brokerage now, but back then I dabbled in mortgages. I had my license, did a few of them on the side, but for the most part I had another broker take care of my business. So what had happened was, we were in the middle of a deal. I was doing a real estate deal, and used the in-house broker that we used at the company that I worked for, and we were trying to put the financing together for a young couple, and we were having a few challenges with it. The mortgage broker said that because of a couple of little blips in the application, that it was not going to be able to be fully funded by a mainstream lender, that private financing was more than likely going to be necessary, and she didn't foresee any issues, and I was fine with that. Well, what ended up happening was the deal ended up going squirrely, and it means that the financing didn't come together. And it didn't come together because she couldn't find a private investor to invest in a mortgage for these people. And private lending can sometimes be a little bit tricky, but with this particular deal, it really perplexed me, because what it was a good solid home in Cambridge, Ontario here. This is the heartland of Ontario, very saleable homes, and it was a substantial down payment, good credit from the borrower, all of that. The blip in the deal was that the borrowers were self-employed. And I don't know, to be honest with you, if she even tried hard enough to get the deal, but she told me that she couldn't get the deal done and that the deal was going to die. I told her that, you know, I can't understand why this deal doesn't come together. This is such a strong deal. What's the matter with these private investors? Why don't they want to invest in this mortgage? So that's when she suggested something to me that, quite honestly, changed my investment portfolio significantly. What had happened was, she asked me, if I felt so comfortable with the deal, why don't I go ahead and invest in the mortgage myself? Okay. Well, I thought she was kind of joking, really, because I was a young real estate agent. I had a family. I had savings, but at the same time, given the nature of the real estate business, I always wanted to keep, you know, some money in my arsenal just in case, you know, business dried up. So I told her, quite honestly, I couldn't afford to invest in this mortgage, but, you know, if I had the money, I certainly would. And that's when she said to me, "You have an RSP account, don't you?" And I said, "Of course I do. I mean, who doesn't, right?" And she says, "Well, why don't you use your RSPs to fund this particular mortgage?" Quite honestly, I didn't even know that was possible. And I said, "Well, hold it here. How does that work? I've got mutual funds." And she said, "Well, your mutual funds, how are they doing?" I said, They're not doing well the last time I looked." And quite honestly, I approached this RSP thing with my head in the sand, because every time I looked at the statements, nothing seemed to be happening with the RSP. So quite honestly, it was sort of a gray area for me, or I should say a black area. But at any rate, she said, "Listen, why don't you liquidate your mutual funds, turn them into cash, keep it inside your RSP, and then fund this mortgage?" And that's exactly what I did. I ended up funding this mortgage. It was a $50,000 second mortgage. The loan to value on it was 80%. We'll get into that a little bit later as to what that means. And I funded it at 14%. And quite honestly, folks, I thought I had found the goose that laid the golden egg. These people paid it quite regularly. They kept it on the books for 2 years. At the end of 2 years, they paid me out. So in other words, what they did was they refinanced the property, and they encompassed my $50,000 second into their new mortgage. They paid me out. I had my cash back inside my RSP, and I was able to do this all over again. I was quite happy. And folks, I found something that, like I said, I thought I found the goose that laid the golden egg. I went on to do that more and more. And as I got more involved in the mortgage business, my wife came into the business with me, and we did it more and more. And it has really changed our RSP portfolio because we invest not in stocks or mutual funds or anything like that. I'm sure that there's people that have had great success with those. I am not one of those people. I never had any luck with it, so I invested with what I knew. I knew real estate, I knew mortgages, and that's what I stuck to, and it's done very well for me. So that's my story. That's how I got involved in the RSP mortgage investing arena. So what we're going to do tonight is we're going to go right into the topic at hand, and I'm going to tell you how you can do the same thing with your RSP. Okay? So let's go into slide number 1 here. The first thing you've got to do is you've got to have your RSP as a self-directed RSP. It has to be in a self-directed account. And more importantly, it has to be with a trustee that allows you to hold arm's-length mortgages. And that's what we're going to be talking about here. Because there are 2 elements with investing in RSP mortgages. You have non-arm's length mortgages, and you have arm's length mortgages. Non-arm's length mortgages are basically, more importantly, these are a mortgage that you would do for yourself or for a relative. The definition that CRA gives us is that a non-arm's length mortgage is a mortgage that you give to somebody that is related to you by blood, marriage, or adoption. So that is non-arm's length. We're talking about arm's length here tonight, folks. I'm not going to get into a whole lot of non-arm's length. I know that there are some people that are big fans of that, and I'm okay with that. That's fine, but that's not what we're going to be talking about tonight, okay? So the more important thing here is to set up your RSP with a trustee that allows you to participate in arm's length mortgages. The ones that I know of, okay, are Olympia Trust, B2B Trust, and Canadian Western Trust, okay? I know that there are other trustees that allow arm's length mortgages. These are the 3 most popular, and these are the 3 that we recommend. I personally use Olympia Trust. I think they're very fluid and very liquid to deal with. They're easy to deal with, easy to access, and so that's the one I use. But I have colleagues that use both of these other trustees, and they have had good luck with them. Okay, so at any rate, what you would have to do is, if you are not with a trustee that allows you to participate in arm's length mortgages, you need to get with one that does. Okay, so that's step number 1 in terms of being able to participate in RSP mortgages. Okay, the second thing you need to do once you have established an account with one of these trustees is your money has to be in a cash-ready position. Okay, so that means you have to have actual cash in the RSP, or you can infuse more cash into it. It can't be sitting in a mutual fund. It can't be sitting in a stock. You can't lend those. Those are the cash is already being, or the investment is already held up in a particular element. So you got to get out of those. You got to be in a cash-ready position in order to be able to invest in mortgages using your RSP. Okay, so go into a cash-ready position. The third thing you want to do is, once you have those 2 elements in place, you want to search for mortgage investment opportunities. And the way that I would recommend you do that is you reach out to the mortgage brokerage community. Let them know that you're a private investor and you've got some money to lend, and tell them what you're looking for, either first or second mortgages. Second mortgages is what I typically invest in. Some people like to do first. That's fine. The yields are usually a little lighter, but obviously the security is a little bit different, so it's a little safer in terms of exposure to your portfolio. One of the things that I recommend you do is if you don't know anybody in the mortgage brokerage community, one of the best things you can do is go on to LinkedIn and mortgage broker. Just punch in the search parameters that you're looking for mortgage brokers in your area, and you'll get a whole host of them. And reach out to these guys. You can even send them a quick message via LinkedIn, or you can get on the phone with them. Mortgage brokers tend to like to advertise their phone number, so you can get on the phone with them, let them know that you've got money to lend for mortgages in the first and second mortgage market. Okay. The fourth thing is, once you do that, you're going to start getting opportunities, and you're going to have to review these opportunities so you can assess whether you want to go ahead and invest in the mortgage. So I have a 6-step process in terms of reviewing the opportunities, and we'll go over that right now. Okay. So the first step I do, of course, is the most important element is the subject property. You've got to establish the value of the property in terms of what it's actually worth in today's marketplace. You want to get into something that's in good condition. I recommend that you stay away from anything that needs any kind of work. The reason I say you should stay away from those is because if any of these loans ever go bad, you want to be able to be in a situation that the property is highly marketable. So fixer-uppers are not as highly marketable as pretty homes. Okay, you've got to have these homes in a good location, and the marketability of these homes has to be high. Okay, so when these things hit the market, you've got foaming at the mouth buyers that want to buy these types of homes, and this is all basically a safeguard in case the loan goes bad. The other thing you want to look at is comparable homes and that have sold and the days on the market. That how long it took them to sell. You want homes that are easy to sell, just in case the loan goes bad. Obviously, the biggest thing here in doing that is you want to review an appraisal. Most trustees are going to ask you to get an appraisal, so that appraisal is going to be ordered by the mortgage broker. You can participate in who you want to have as an appraiser. Most mortgage brokers will recommend some to you. I would recommend that you ask the broker who is the appraisers on the home trust list. That's who I would use as an appraiser. Home trust is a equity lender that does tend to specialize in harder to place mortgages. They are usually more critical in terms of their appraisal process. And so if you use their list to establish the value, or their list of appraisers to establish the value of the property, it's probably very prudent. Okay, so you want to make sure that you've got a good, solid property, very marketable. And there used to be a guy down in the States by the name of Joe Land. He used to teach this style of investing, and he had a saying in the business called loan to own. So in other words, if you wouldn't want to own this house, you don't want a loan on this house. Okay, so that's element number one. That is probably the most important thing, is the subject property and those elements that we talked about. Okay, the next thing we want to look at is loan to value. Loan to value, very simply, is just a ratio between what the mortgages, the total sum of the mortgages that are on the property, in comparison to the actual market value of the house. So here, as an example, if you have a $100,000 mortgage on a $200,000 house, that means that the loan to value is 50%. Okay? My personal rule of thumb on lending on mortgages is I typically don't like going beyond 85%. So for example, if it was on this particular house and these people had a current first mortgage of $100,000 on this property, I would not lend more than $60,000 as a second, all right, which would leave me at a 80% loan to value. Okay, I said I'd go to 85%, so I would lend just a little more. I'd lend a $70,000 on this property, all right? But that's not a hard and fast rule. You can decide on whether you feel comfortable at 85. You can take some guidance in terms of from the broker, and you can also take a look at the marketplace. If you're going into maybe a softer marketplace that has a little bit more time on the market, you might want to claw back that loan to value, maybe to 80 or to 75. That's not a hard and fast rule. That is your decision to make. But I would recommend in our marketplace where I am, Cambridge, Kitchener, Waterloo, I don't like going beyond 85% of the value. One other reason that I don't is I look at the exit strategy, because when I place a loan, obviously my mortgage, my second mortgage, is going to be sitting at probably somewhere between 13 and 16%. The borrower doesn't want to continue to pay that forever. So what I'm going to do is I'm going to set this mortgage up in a way that these people have an exit, so when they refinance, that they can pay me out. And as you know, the current rules right now is you can't refinance a property beyond 80% of its value with a mainstream lender. So if I go 85%, what I'm banking on is when they exit that the property value has actually gone up. Okay, so and of course they've amortized the loan a little bit too. Okay, so you got to set it up, folks, to be able for them to be able to exit. All right, so my loan to value personally 85%, but that is your choice. You can decide on how high you want to go. Okay. Another element I want to look at, and I know I mentioned here in this slide, it says exit strategy, is how much did the current owner pay for the property? You're probably wondering why I put that in, and quite honestly, I used to not care so much about this before, but I do now because the market has increased so much that I don't necessarily turn loans down based on this particular principle, but at the same time, I do take it into consideration when I'm lending. So in other words, if somebody paid, $200,000 for a house, and now the house is worth $300,000, and they want to pull out 50 grand, well, that 50 grand is not, in my mind, is not really their 50 grand. It is their 50 grand because it's their house, but this was all appreciated money. All right. So sometimes you may get somebody in a situation where it may be just easier to get a loan than it is to sell the property. The last thing you want to do is be the guy that they went to pull the money out, and then all of a sudden they stop paying you, and you're whistling for the money. It's not that you don't have obviously rights here in terms of getting it back through power sale and whatnot, but I always find that getting into hard-earned money from the borrower is easier to deal with, and they respect the loan more than if it's found money, okay? But that's not a hard and fast rule. It's just something to keep in mind, okay? So obviously purchases are probably a little bit more safer than a refi, but refi is going to be probably the mainstay of private mortgages because they're going into a purchase with real money. With refis, it's appreciated money. But that's just something to keep in mind, okay? The next thing is you want to know what they're going to do with the money. And the reason I want to know that is they got to be putting themselves in a better position than what they're in now. Let's face it, these people are coming to you to better their situation. They're borrowing from you at a high yield, so when you lend them money, you got to be putting them in a better position than they are now. If they're going to end up with higher payments than what they got, you're not doing yourself or them any favors. You're probably just going to set yourself up for failure in terms of a bad situation. So find out what they're going to do with the money. Typically what I find what people do with this kind of money, what they're going to do with the money is they're going to pay out other debts. Credit card debt, maybe a car loan, student loan. They're possibly going to help family member out. Maybe they need some help with a medical situation, that sort of thing. They got to be putting themselves in a better position, folks. If they're not, stay away from the deal because it's just a bad deal. Okay? Next thing you want to do is you want to take a look at their credit history. Now, one thing I want to warn you about here is that private money borrowers typically do not have good credit. That's why they're coming to you, okay? But at the same time, you don't want to be getting into a situation where you've got a chronic bad borrower or a chronic borrower that doesn't pay their debts. So when you're looking at the credit history, it's typically going to be bruised. You're going to be looking at the other debts in terms of how they're servicing those debts, okay? The one thing that you definitely want to look at that's not on the credit history, believe it or not, is their current mortgage that's in place now. Is it in good standing? You want to make sure it is in good standing, okay? Because, you know, you don't want them robbing Peter to pay Paul. So is their current mortgage in good standing? And you can find that out by asking for a mortgage statement, okay? And they can provide that. You can condition that as part of your commitment, and we'll talk about that in a bit. But you want to make sure that their mortgage is in good standing. You want to look at if they've ever declared bankruptcy or have they gone through a credit proposal. A lot of these people have, okay? If you want to make sure that they're clean after that kind of stuff, and the last thing you want to do is get into anything with a double bankrupt. If they're double bankrupt, folks, they're going to do it again, and they're just going to take you along right with them. So stay away from double bankrupts. But bankruptcies are very common. I mean, they're very common these days. I've been in the business 28 years. Years ago, like when I first started, bankruptcies, you hardly heard of them. Now, they're pretty common, and it's almost scary how common they are, but nonetheless, they are what they are. The other thing you want to look at, and you want to ask the mortgage broker that helps you out with this deal, is how long is it going to take for them to clean up their act, clean up their credit, because you want to be able to get these people out of this deal so that they can pay you back and get back on their feet, and you can put out the money to somebody else, okay? So, again, as I said, you're probably looking at spotted credit, but it is what it is, all right? The next thing you want to look at is their capacity to service the loan. So when I say that, is what you want to look at is you want to look at what a lender typically looks at. They look at what's called a GDS ratio and a TDS ratio. Very simply, what that means is that's their debt service ratios in relation to their income. That's a percentage of their income. In private lending, you typically don't deal with GDS. GDS is more of a term used amongst the mainstream lenders. TDS is what we're going to be looking at here more than anything else. So in other words, what we want to do is we want to find out what all of their debts are, including if you fund your mortgage as well, the payment on that, what the total amount of that is going to be in relation to their income. I do not like seeing a total debt service ratio of any higher than 50%. All right? So if they make $5,000 a month, you want to make sure that their debt service ratio isn't any higher than $2,500 a month. And by debt services, I mean mortgage, insurance, taxes, heat, car payments, credit card payments, that sort of thing. Those are the things that we're looking at. We're not looking at the cable bill. We're not looking at their grocery bill. That's not part of the total debt service, okay? But you want to make sure that their total debts do not exceed 50% of their total earnings. You get into any higher than that, you're probably just asking for trouble, okay? So you want to make sure that they can handle the debt that you're going to be throwing at them, okay? Once you have all that in place, once you've decided that, hey, this is a deal that I want to go ahead and fund, then you're going to give them what's called a commitment, or otherwise known as a commitment letter, all right? In that commitment letter, you're going to stipulate the amount of money that you are prepared to lend them, okay, and the loan to value. So you can be very specific, and like if you're a second mortgage lender, you can say that, you know, I'm lending on 200 grand. You got 100 grand as the first. I don't want to lend any more than 70. and I want to verify that that 100 grand is in fact 100 grand. You're going to prove that to me. Okay, so that's part of your commitment. You're going to ask them to prove that to you by way of a statement. That's where you're going to put in your interest rate. All right. Typically, private money in my market goes for anywhere from, I would say, 6 to 10% on a first mortgage, and anywhere from 12.5 to 18% on a second. Okay. I can tell you right now, there is a lot of private money in the mortgage in the market right now. So the lending or the interest rates are a little bit. Those 18% mortgages are harder to get. You're going to be able to get them, but they may be attached to too much hair. So you don't want to put yourself in a situation. Don't go after the big return, folks, and be attached to a mess along with it. So just be very prudent of that. You're going to get probably anywhere from 13 to 15% in this marketplace. All right. You're going to stipulate the term. The term is basically the amount of time that you're going to give this mortgage for. Okay, 1 year, 2 year, 3 year, 5 year. I don't like lending any longer than usually 2 years. Okay, I love 1 year mortgages. I will do 2s. Sometimes I'll look at longer, but not very likely. I want to be able to get my money back out, and I want to sort of put a fire under them so they can clear up their mess, so they can pay me back. All right. So terms anywhere from 1 to 3 years at the most. Some lenders like to line up the term with the expiry date or the maturity date on the first. So if the first mortgage is coming up, say next year, then you might want to line up the maturity of the second on the same day, so when they go to redo their financing, renew, then they can kind of swallow everything up into one deal. And that's not a bad way to go, provided that you're not jumping behind a 5-year commitment. I don't recommend going that long for more reasons than not, but that's what I would recommend. The terms, you can be very specific about the terms that you want in the mortgage. Obviously, you want to make sure that they have insurance. You can stipulate that whether the mortgage is open or not, whether they can pay it or not. Prepay it. That is totally up to you. You can get some guidance from your mortgage broker in terms of writing up terms, standard terms for a mortgage, and of course your lawyer as well. So your lawyer can give you some guidance in the terms that you put into the mortgage. Conditions in a mortgage. This is very important. So these are where you would address that you want certain things paid out. So with the proceeds of the mortgage, you can demand that certain credit cards get paid out, or certain loans get paid out, or that something gets discharged. You can actually demand that, and when you do that, you can be specific about having the lawyer take care of those discharges directly. So you don't have to worry about, if I give these folks the money, are they going to actually use it for what they're telling me they're borrowing it for? You can be very specific about that. You can condition it right into your commitment, and you can be sure that that's taken care of. The next thing, of course, is fees. And where I'm coming from on fees is typically what you're going to pay your lawyer for setting up the mortgage, because there is legal fees for setting up a mortgage. So what I always do is I push those fees back to the borrower. The other thing that I push back to the borrower is I push back the actual fees that I pay my trustee. So if I'm just going to show you that, if I can find it, if I go over here, this is the Olympia Trust account. If you go into fees here, this is a fee schedule for arm's length mortgage. It shows right here. It shows $100 to set it up, $10 monthly administration fee, $25 for an additional advances. So if you stage it in terms of how they get their monies, $25 for discharge, $25 for a payout statement, all of that stuff. You do the math on this, and you want to make sure that all those fees get paid by the borrower. Okay, you don't want to be paying for these yourself. So again, don't forget that if you're paying this stuff, if you've got a mortgage on the books for 24 months, say, you've got to make sure that you do the math on this. That's going to be $10 times 24 months. All right, not just 10 bucks. All right, so you can throw all those fees back to the borrower, and you would, of course, that would be held back from the proceeds of the deal. All right, so that's how that works. Let me go back to the presentation, and then of course bonuses. Sometimes you can sweeten the pot with a mortgage where you don't necessarily get the returns up front. You can do it in terms of a bonus. So rather than lend the money at, say, 14% or 13%, you may want to lend it at 10%, let's say based on a one-year basis, with a 3% bonus. And that way you're still getting your 13%, but you're getting it sort of in a different way. And you can do that one of two ways. You can hold it back from the proceeds of funding. So in other words, if they're borrowing 50 grand and you want to bonus it by, say, $3,000, your actual advance is going to be $47,000. Or you can do it on the back end. Most people are going to prefer that you do it on the back end because they need as much money as they can from the deal. So when I say that is, they borrow 50, but they're going to pay you back 53. Okay, so that's just an example. Okay, but you can bonus it. The other thing that bonusing does is it also helps make your mortgage saleable, because mortgages are an asset; they can be sold, and when you sell the mortgage, you can keep the bonus and then sell the mortgage for its face amount. So that's another good way of making money in the mortgage business. You don't even necessarily have to keep the mortgage on your books. You can sell the mortgage and for a profit and let somebody else finish it out. All right. So that'll all be addressed in the commitment. All right. The next thing you want to do, step number 6, is executing the documents for your trustee. So we're going to go back to my other screen here, and I'm just going to show you what I mean by that. My account, as I had mentioned, is with Olympia Trust. So some of the when you log in, you're going to be going into the forms section, and this is where you execute all these forms over here. You can usually get a breakdown of what's going to be required for the mortgage, and so it gives you a breakdown of what you need. So it gives you a breakdown of what you need for the mortgage, and then you can go all the way through that, and you know exactly what you're dealing with in terms of what you need to provide your trustee. Now, if you don't have an account with the trustee, you're obviously going to have to open one up. Okay, and this is an application for an account. I'm going to give you a heads up here right now that if you open one up with Olympia Trust, this document is multiple pages long. I can't even remember how many pages it is. I think it's 41 pages long. Folks, you only need page 1 and 2 to open up an account. So when you print it, make sure you only print page 1 and 2. If you've already got an account with Olympia Trust, you can just use this form here to transfer some money over to your account, your Olympia Trust account. Okay. Most of these trustees all work with very similar documentation, so this will be all encompassing. This is just general information here, as we talked about before, and then these are the actual documents that you're going to execute when you do a mortgage. The lender, or I'm sorry, the mortgage broker can help you execute these, but they're pretty simple in terms of how you fill them out, and then you're going to send these off back to Olympia Trust and to the lawyer so they know what they're dealing with. This here is basically a form that we use to collect payments, so you're not actually chasing checks. The last thing you want to do is be chasing payments, so you want to have an electronic payment schedule for them to pay you back. Usually I like setting up my mortgages on an interest-only basis. It's very simple. They borrow 50 grand, they pay back 50 grand, and they service me with the interest through the term. That's the easiest way to do it. You can amortize these things if you want as well, but I personally like to do interest only. All right, and we've been in a pretty healthy market that we've been able to get away with that too. Okay, because the market has been going up. These are just some documents for the solicitor that they have to execute in order to give your trustee to make sure that everything went the way that the trustee wanted it and that it conforms well with CRA. And of course, these are just a breakdown of the fees again. All right, so you have to execute those forms once you've decided you want to go ahead with the mortgage, and all the money is handled by the lawyer. So this money is going to be sent to your lawyer from Olympia Trust, and then they're going to pass it on to the borrower's lawyer. Sometimes it's one and the same. Typically, anything under 50 grand, they can do it with one lawyer. If there's more than 50 grand, they need two. Okay. So at any rate, all the monies is handled through a lawyer. You're not handing over a nickel to these people because the lawyer is going to do it properly and make sure that everything goes well. All right. And then the last step, of course, is wash, rinse, and repeat. You're going to love this strategy. I think you're really going to enjoy the returns you get on this thing, and you simply do it again and again, and watch your account grow. All right, and what I'd like to do at this time is, first of all, as I said, I'm a mortgage broker myself, and if you'd like to register with us to receive investment opportunities, I would ask you to go to my website, waltermontero.com /mortgage investor, and on there you're simply going to fill out a form stating your name, your address, and where you're from, phone number, how we can get a hold of you, email, and how much money you got to invest, and whether you're an RSP or a TFSA investor or a cash investor. And you can do it any way you like. But I would certainly invite you to do that if you'd like to do that. I'd also, I don't see any questions in the chat. I will give you a couple of minutes to fill in a question if you have one. But folks, that's the end of my presentation, and I hope you enjoyed it. I can't tell you how much this investment strategy has helped me. It's saved my portfolio. I'm quite happy with the returns I've got. Have I ever been in a situation that went bad? I've been in a couple. Most of them turned out very well. What ended up happening is I ended up going through power sale proceedings. Most people, in fact everybody except one, did end up coming up with the money and paying me out. Some of them did it either through family members or just through another private lender. And then there was one that I actually took a hit, lost a little bit of money. But when I do the long math on how mortgage investments have served me over the years, I'm actually ahead. You certainly want to avoid those, but at the same time, you can run into them from time to time. The key here, more than anything else, is that if you follow the steps that I laid out to you while through the presentation here, if something goes awry, you should have enough fat in the deal that gets you out of the situation where you can get your money back, and you don't have to worry about that. Okay. So folks, I don't see any other questions here coming up on the screen. I want to thank you again for taking your time and coming on to the webinar tonight. And if you have any questions for me even afterwards, you can email me at walter@maximumresults.ca, or you can call me at my office at 519-624-9222. Okay, I want to thank you again, and folks, have a great evening.